Yeah, hi. Thank you all for joining us for this landmark Silver Jubilee Wealth Creation session. Raamdeo ji has obviously had this fascinating journey, 25 years of going into hibernation for nearly 2 months every year to do the manthan, to get new frameworks, to read new books, to get new learnings, to introspect your mistakes, to plug those gaps, and then move on in this journey of investing, so that this engine, this investment engine, remains contemporary year after year after year. And today, what he's done is remarkable. He's basically put together all the learnings of 25 years in 25 questions, in 25 investment frameworks. It is now all out there. So you don't have to go through study by study every year's 25 years of studies. You can go through this one, and you have all of those frameworks at one single place. Thank you very much, Raamdeo ji, and my compliments, hearty congratulations on this 25th study, but more importantly, the journey of 25 years non-stop consistently. It's truly remarkable. We're very, very excited, and I'm sure you must be equally excited to do this study.
Yeah. Every study I feel that I should have done it 5 years before. So this one checklist again, it is going to make me disciplined. Yeah. Dhruv Mehta, who is also co-author, Dhruv and Srinath, thanks very much. They are the co-authors, and Dhruv is a wealth manager, and he said, one of the things, the moment he saw the checklist, he said, the one thing active managers don't practice is the checklist. They don't have their own checklist. And we didn't have one, in the sense that it was not, QGLP was there. In fact, that's a master checklist. And within that, what is the sub-checklist? Now, here we have, right. It should help us, at least it will help me for sure, to become better investor and better, to avoid some mistakes. So in stock market, when you want to improve your performance, one of the things is that you should be able to check out the losers. So I hope I'll pick up less losers and more winners.
Absolutely, absolutely. So Raamdeo ji, there are quite a few questions from the audience. I'll try and see how much I can cover in about the next 60 minutes time, but you have like tons and tons of questions out there. The first one comes actually out of one of the slides that you presented, that we were at 55-56% market cap to GDP on 31st of March. And then you presented the December picture, which is at nearly 100%.
100%, yeah.
Right? And compares with the 2008 level of 100%.
Yeah.
Although the peak in 2008 was more like 160%.
Yes.
So how do you think about these rich valuations? You are a buy and permanently hold investor. Does it deter you? Does it bother you? And how do you think about this?
So when you see that graph, it scares you. It starts making you believe, is it that all-time high again, double top kind of situation?
Yeah.
But see, the point is the shape of the economy. I think in 2008, it was after it started from 40-50%, it went to 170, and then it was on the correction phase, it was 103 or something like that. So that economy had expanded big time. This time, economy has contracted. Economy has not got its due growth in last 4-5 years. So I would think that yes, it is a point to be taken. You have to be very careful. If you buy the same popular stocks which are overly valued, I'm quite sure you're not going to make a lot of money. So you have to find your set of companies which are going to be, which are going to, even if the economic growth picks up big time, I think markets may ignore some of those richly valued companies. So you have to find companies which are going to do well, and I'm quite sure quite a few companies which will be different set of companies. I'm no competent guy to figure out whether economy is going to, I'm always bullish. So I would think that economy is going to grow at 6-8% or maybe even higher. Next year is going to be off the charts, like it could be 14-15% kind of growth. And then after that, government will try to definitely, build on that. They will do everything to build on that, because they'll get tons of taxes and they'll love the taxes. So once the tax starts coming in, they'll say this is the right way of doing it, and hence they'll build on the growth.
Yeah.
So I think I'm a little more optimistic on the next 2-3 years of GDP growth rate of 10, 12, 13%, and we'll get our opportunities to buy. We were not scared when market went to 50% to GDP. So there's no question of getting scared now at this juncture.
Yeah. So this is fantastic. Basically, we normally look at PE, or we normally look at market cap to GDP, but the E is 2% of the GDP. if you look at market cap to GDP, the GDP is not grown at 8% like it grew for 5 years ending 2008.
Yeah.
And I think that is why they say that history never repeats itself, it rhymes,
it
right?
rhymes, yeah.
And there are some differences always, and there are some differences this time around as well. And you have never tried to time the market, whether it's 50% market cap to GDP or 150% market cap to GDP. You earn cash flows, you deploy them. November, you got 150 crores, you deployed them.
Yeah.
Now, but the whole world throws barrage of questions at you in terms of what do you think about the market and timing of the market. What is this whole timing thing, and why don't you engage in it?
Yeah, so actually if you look back my own style, even before I met Buffett in '94, I heard about him and started learning from him. I was a voracious stock buyer. I mean, I was never I mean, we didn't know what is a Teji market, what is Mandi market. Just there is one market, is a market. You got to go there, buy something with a margin of safety, 100 crore stuff, you buy it for 50, 30, 40, and just make money on the go. We used to buy small mid-cap companies which are not that impacted by what's happening in the speculative side of the market. So that is my evolution, and I never saw money. I always had 100% invested in cash, never 101%, never 99, 100% invested in cash, into equities. So that is my evolution. I never timed the market naturally. When we read about Buffett and all, they said, don't time the market. So that became kind of a very well thought out mantra, and we practiced it, and it works very well, because half the time, 99% of the time people are worried whether should I buy, should I not buy, should I stay in cash, should I sell. I said, boss, this is the biggest headache you have ever had. And if there are million guys are trying to do this, how can you outsmart anybody? So I have seen, I have never been able to be good at it, so let's not bother about it. Let's take on the chin. We are not for 1 year, 2 year, 3 year, we are there till it takes. I mean, I don't know. I mean, I'm 63 now, maybe till 80, 85, or maybe till 90, whatever. I mean, till I feel like coming to the market and I remain passionate, I'll keep having 100% investment in equities, and we have seen power of compounding, what 25, 30 years makes. I mean, Motilal Oswal's stories that of compounding and super compounding. I mean, if I compound for 50 years at the recent rates which are not that high, I think we'll have a lot of money. A lot of money means actually we don't know what to do with the money. So the compounding makes money, compounding and equity asset class. Even at 10, 12, 15% compounded, you make so much of money, and you become lucky if you are there in the market. Who knew? I mean, I'm telling you, closer COVID, a lot of brilliant people, they said, this is a different time, let me get out. Even Buffett presented one of the most pessimistic presentation in the annual meetings. I said, why? The world is not coming to an end, yaar. I mean, not that 99% people are dying. Only 1% people are buying of the positive. And positives themselves are 1%. So we are talking about 0.01% death rate. So I said, it's not coming to an end of the world. And why should we be so worried? And now you see what has happened in just 8-9 months. And central bankers, they are bigger than gods. They will handle anything to whatever challenges come in the economy. So having central bank on your side, I mean, we are reasonably sure, particularly in India, which has got $2,000 per capita income, that economy will keep growing, newer companies will keep coming, and will keep making money at sometimes at 10%, sometimes at 15%, and sometimes even 25-30%. You can become lucky. So I am pretty peaceful, and I don't bother actually, and I don't advise anybody to ever practice timing. If you don't have a stomach for 100% of the equity, as I have, you are well off with 50%, 40%, 10%, 5%, or no equity at all. That's very good. If you're really scared of up and down, then don't come to the equity markets. You might have seen, we are never happy or unhappy. Of course, we are very happy when market is up 5%, but definitely not unhappy when market is down 5%. That is what is most important in equity. The real price you pay is that you should be happy when markets are down. If you can do that, welcome to the party.
Absolutely. And you spoke about compounding, and Einstein said it's the eighth wonder. Buffett's never taken cash calls in the sense that Berkshire has $150 billion or whatever cash, but by and large he's an equity guy all throughout his life. This magic of compounding probably today is even more true than ever before, because the fulcrum of interest rates, which drive all asset valuations, are lower than ever before, and for longer than we ever thought. How do you think about magic of compounding in this new era, in this new light?
See, magic of compounding is on for last so many years. I mean, so many years, what centuries, I mean, since it has been discovered. The issue is that very few understand and fewer of the few practice it.
Yeah.
I mean, compounded thinking is very simple to think with the rule of 72 and now with the calculators you have.
Yeah.
But nobody practices. I find it very funny. I mean, top corporate executives, industrialists, they have no clue what is compounding. And as somebody says, compounding, if you don't understand, you paid. And if you understand, you earn it. So, it is one of the biggest opportunity. Despite we are talking so publicly, I think nobody would even bother. And it is such a simple and a small concept that there is not much of reading even in Google. If you go to Google, you don't find much stuff in the compounding. So, compounding is the biggest source of wealth creation, and it is not about the pace of wealth creation. It is about the number of years in the market.
Yes.
So, even if you are very average kind of a guy, but if you are there for 30, 35 years in that asset class, I think you will do very well.
Yeah.
So, practicing compounding, one is understanding and second is practicing. That is even more difficult. That is the key.
Yeah. I did see that your first eureka moment in life was when you understood the importance of a return on equity and quality.
Yes.
Right? That was Eureka 1.
Yes.
And then you made tons of money on that insight. And then you stumbled upon, I think, the next Eureka moment, which is growth. Right? And that Buffett is probably spoken less about, or globally it is spoken less about. Right? And I was very, very surprised to see in your wealth creation study presentation that while a lot of the wealth creators, 8 out of the top 10 wealth creators are consumer companies, 28% of all the net wealth created in 25 years is from consumer and retail companies. But there are 2 companies that have fallen off the ranks, right, of the top 100 ranks, which are in the consumer space, and the very, very strong brands, Colgate
And Castrol.
and Castrol. And there, G has been either the lowest and in another case actually missing, right? Do you want to talk about this Eureka moment of G, which is probably the less discovered part in the overall quality investing jigsaw puzzle?
Yeah, so one of the things we saw is that in 2014 study that yes, quality is one parameter because of franchise and sustained high cash flow and free cash flow. The companies create wealth and you make money. But that has also been exploited because what Buffett did, Buffett started as a value investor, deep value investor, nets. And then Manjar came and he taught him that you should not buy bad companies at very cheap price, but buy great companies at fair price. So that's what led to Seas Candy, American Express, Coca-Cola, Gillette, all those franchises they bought. But a great thing they did was that all this theory they wrote in their annual reports every year. And then over a period of time in 90s, when I heard about him, in 94 I heard about Buffett, and that time no book had come on him. Only you had to learn about him from his annual letters. I read all the 20-25 annual letters and became biggest Buffettologist in India. Okay, and then after that the book started coming in. I mean, all over the Buffett became so famous, and internet did exponential job. So quality became mantra and quality became very expensive.
Yeah.
So now by having only quality, you cannot make money. It is overexploited segment of the market.
Yeah.
Now, so what is that which is not exploited? Is the quality and growth. That we realized. So G is equal to R. So if you can estimate growth of the company in a superior way than the markets are blind to whatever is known till date. I mean, they're very efficient for whatever is the information till date. But the information which is yet unfolded, and I'm not saying that we are great in estimating that, but you can have because you understand the company so well, you are able to feel the continuity of growth, or you might get some insights about exponentially the growth back-ended. That's where the opportunity is there. So the quality and growth is extremely, only quality will not make money, as you said, or it will make a very mediocre money. But once quality and growth are combined, and particularly if you can get ahead of the quality or get ahead of the growth, or if you get ahead of quality and growth both, I mean,
Lollapalooza.
And then you have the multi-bagger in hand.
Yeah, absolutely.
So, and you need to hit 1 in 2-3 years. You know, the multi-bagger type.
Well, if you hit 1 in 5 years also,
Yeah, it's a lot of money.
You're home, 100 baggers.
Yes,
yeah?
yes.
So we spoke about Q,
Yeah.
Eureka 1, we spoke about G.
Yeah.
And now talk about L. You recently got very excited about the reinvestment capability over the long term.
Yeah.
You know, even a company like Reliance, through this capability, has managed to compound earnings and stock price at 16% for 25 years.
Yes.
Largest wealth creator.
Yes.
Talk about this.
So elephant is dancing.
Yes.
Successfully. And that is purely because of the reinvestment rate, which Ambani family has been able to do.
Yeah.
So, I mean, I was reading Terry Smith's wonderful book, very new book. I read it in September 20 only, I think, or sometime like that. And it's a wonderful book. And there I was reading at the end that power of reinvestment. So I was knowing the reinvestment, but it made me think that when the company itself reinvests, it is able to reinvest 100 cents of the post-tax profit, which is quite commonsensical. But when you do it through the dividend, if it is 30% or 35% dividend tax, so you get only 65 cents in your hand. And then when you go to buy that 65 cents, use it, you buy at price to book 3.5, because Sensex or index is at 3.5 book. So on an average, you pay 3.5x. So what you get in terms of reinvestment out of your $1 of post-tax profit by way of dividend is only 19-20 cents. Absolutely. But when the company reinvests before paying dividend, they are able to create assets in a 3.5 book or 4 book company at price to book 1. And that sustained reinvestment at price to book 1, I mean, of course, there should be opportunity also. So the companies in the early stage, they are the ones which are hungry for growth. They want a little bigger plant, they want bigger working capital. So they are able to very successfully deploy. Even Infosys of the world, in the beginning, on one technology park, they could set up another technology park and grow at 100%. Because you have 1,000 guys, 2,000 guys, put up another 5,000 guys, and you will have, so you are able to deploy literally a very profitable company like 70-80% growth company can redeploy the entire 1,000 crores or 500 crores into a new software technology park. Absolutely. So that really built that base and the profitability. So the power of reinvestment, I mean, since it is a very new one, we have not, but we understand it's very common sense. But that's one of the reason the compounding takes place, and probably it has power to see the future of growth, because the capex is happening ahead of actual growth. Markets wait for the sales and profit to come in next quarter or next year. But because of the capex has happened in the cement plant or steel plant or chemical plant, the growth is ahead. So, I think this is a very good indicator for future growth.
Yeah. The other great insight of this study, and you presented some contrasts, was the power of asset turnover versus margins.
Yes.
Traditionally, profitability is only associated with margins. Right? And a higher margin company is perceived to be more profitable than a lower margin company.
Yes.
And you drew a contrast of a 0.8 times asset turnover company with a 3 times asset turnover company. And then you went on to say that a business may have infinite margin, but if the asset turnover is basis points or 10, 15, 0.1, 0.15, like the telecom sector, no value is created. You want to talk about this, learning of yours this year?
Yeah, this DuPont analysis of 3 margin, asset turn and the leverage. This is one of the most wonderful thing, which. But when you go to meet the corporate executives, or generally, in the competition, not so much the analyst types, but more, kind of a business practitioners, they have no clue of the asset turnover. They are all, traders make money because they have the fantastic asset turn and low margin, 2%, 3% margin, but they'll turn it like 100 times, 50 times. Whereas the companies, I've gone through the entire 50 companies of the Nifty. Most of the companies have 1 or less than 1 as an asset turn. So, and when you ask this question, they feel very bad. The management feel very hurt that it takes 12 months to turn the capital. You're very profitable. They're very focused on the profitability, but they don't bother about what is the asset turn. So, you have say 15% net margin, but if you turn the asset only half the time, you're making hardly 7.5%. It's such a difficult job. And if you're making 15% margin, all sorts of competition will try to get in. So the smart guys like this Cadbury's and Levers and all these guys, they have mastered it. Their net margin will be more like a 10%, 12%, 15% of Lever is kind of a history, but more like single digit types. So nobody thinks about their business as a good business, and they don't want to compete there. But their asset turn will be 6, 7, 8, 10, and that gives them ROE of 60, 70, 80% or probably 100%. So this magic sauce of asset turn is very, I mean, it's not nothing new, but really bring it to the fore in terms of when you find a new company which has a high asset turn. The consumer facing companies have that probability that you can do your debtors are zero because it's all retail. You get the money across the counter, and supply chain is managed in such a way that asset turn is very high. And then if you are able to get 10-12% ROE, so when you are buying new companies, you should be very conscious of this asset turn. Is it the company, does the company have potential to go to from current 1.5, 2 to 3 or 4 or 5? That could be a big thing for wealth creation. I'm quite sure the moment company crosses 2 asset turn with a 12-13% net margin, I think you are going to see massive cash flow and very good appreciation by the market.
Yeah. So putting this all together, quality, the growth, reinvestment, so dollar gets reinvested as dollar rather than 15 cents to the dividend route. And then the power of asset turnover, where the world's focused on margins, competition comes through margin. You are focused on keeping the margins at reasonable levels, but turning your asset, right? This is what creates the magic of compounding in corporations over a period of time. When you put this all together, I mean, QGLP has done wonders to you over the last decade, but it has had its weak moments, 1 or 2 years. So where did it really fail? Did it fail?
Yes, it did disappoint me. I mean, I was surprised when I started in 2014 and 2014 to 18, every year, 14-15% outperformance, 2% per month. I said, there's some magic tool or something like that. I mean, we are gods or whatever. I was really surprised, and I used to ask Dhruv, how exactly this works? I mean, long term it is not going to be more than 4-5%, but how do you handle this? So he said, it will go. So he said, it will go. I said, how will it go? I said, I don't know, but it will go. He was sure about that. So it went.
And you were sure about it eventually?
Yeah, I was sure that it is going to go. So it will go. It went. मैं बोला चोरी का माल है. So वो चलेगा नहीं. So वैसा हुआ. अब सवाल के जब जाता तो बहुत दर्द करता है. And a lot of people, they had come looking at our performance in the past, and so it will come. It will come, and it will not be that high, but definitely it will come. That also I'm quite sure.
Absolutely.
So where it went wrong was that economy, we paid for the full growth in the economy, and that thing I showed you, that economy has a it slowed down unexpectedly, and we paid for the full growth. Like we thought 7-8% is granted. Under the new government, it will be even higher, or whatever is the outlook for the companies or business underlying. We forgot to see what is the underlying cyclicality to the GDP growth, and we are not some great macro guys, and we don't have any forecasting ability of how good the economy or how bad. After ILFS, the way economy slowed down, I don't know, the whole NBFC sector, whether all banks, they froze, and that hurt the economic growth, and whole lot of automotives and all. They saw like crazy kind of a decline in their, in fact GDP decline was not that high as much as a lot of underlying businesses. Maybe even RERA, that slowed down the real estate. So many things happened, and economy slowed down and growth collapsed. When the growth collapsed, you have paid for the growth, and that growth didn't turn up. So you underperformed. And already in first 4 years, the same company, because of buy and hold, you have squeezed the lemon big time. So that's what really happened. And now you can say we overstayed with the company, looking back. But that's what really happened. It was all wonderful companies, and they're all coming back. We stayed with them, and now the same companies are almost touching new highs and retracing back. But I think when growth momentum goes away and you have paid for it, then you have a problem. If you're not paid for it, then it's fine. If you bought something at 15p, 25-30% ROE, companies will not disappoint you. But if you have paid 80p for 40% growth, actually it is very cheap. At 80p, if you have 40% growth and it sustains, you are going to make tons of money. But if that 40 comes to 5%, 10%, or actually it ended up negative growth, you have to give in to 50% decline, 70% decline in your wonderful company. Some guys they said, "Will you have Aisha for your breakfast?" You know. So that kind of comments also came. So okay, I mean this is a part of growth investing, and you get shocked. I mean if growth is the core of the thing is growth, you will get. I mean it's little speculative in character, so you'll get some wrong end of the growth.
And I know that you followed that up with 3 studies. One where you came across growth advantage period, trees don't go to the skies, right? And every company has a finite period of high growth.
Yeah.
You came up with one on management, inspired by financial shenanigans. And the third one was about valuations also.
Yes.
That beyond 2 peg, you really don't make
so
multi-baggers.
practicing the discipline is very important.
Absolutely.
Practicing at our own end, and I think probably this checklist will also help in terms
practice.
of bringing. And you have been more instrumental now in bringing that discipline. So as we become more disciplined, I think QGLP is a wonderful piece. I can tell you this.
Undoubtedly.
The only issue is that how disciplined you are. Implementation. How disciplined you are.
How disciplined you are. So when you look at winners for a year versus 3 years versus 10 years. Right? What are the differences in those? For instance, if there's a 100% return stock in 1 year, but there's another one at the same time which you think can give you 25% compounded for next 10 years. That's 10 times multiple of course versus just a one-time doubler in, So what are the differences in shades of these companies when you evaluate one versus the other?
Yeah, so the issue is that what company you have in the portfolio. That's where the dilemma comes. I mean, the company which is going to be a little slower is part of your portfolio as a long-term buy and hold. And then you come across some exciting company which is growing at 40%, hello at 25p. Then how do you do this adjustment? And how much of that new company you buy at the cost of the new older company? Now, see, when you are in the phase of, this is where the inflow and outflow helps. I mean, changes the entire contour. If you are every day getting some amount of inflow, then inviting the new company into your portfolio, that becomes much easier without disturbing the old one. And you can still make change the mix. But if you actually have outflow or no inflow into the fund, then what happens is you have to actually cut that beloved company and find a space for the new one, which becomes a little more painful, and that freezes me in the sense that I don't buy this, but index has that. So that creates a little bit of mess. I mean, we have to do a better job on the whole.
Yeah, you've done investing for decades, right? And the world is really changing right now. Digital is the new reality. It's creating all the wealth. Nasdaq's really the rock star. There's digital in existing businesses, and there's wholly digital businesses. Terry Smith's largest holding is Microsoft. Bailey Gifford's transformed itself to so many digital investments. One of the most successful Fidelity investors have done this so well. Buffett has himself created a lot of wealth in Apple, right? How do you think, as a veteran investor, how will you unlearn, learn digital in existing businesses, wholly digital companies? How do you think about this animal?
Yeah, so fortunately there are not many listed pure digital companies. Otherwise I have to break my head in terms of trying to understand, and they are not cheap. Private equity is already squeezed, so they are getting listed at some fancy prices. So being old and to some extent we are value investors, we find it very tough to get reconciled with 80, 100, 200p multiples. So that's a challenge, but I think we'll learn. I'm quite sure that next 20, 25 years there will be a lot of companies which will be digitally powered or pure digital company. So first round would be find the companies where businesses are impacted positively by the digital prowess the company has, particularly financial services and all, say insurance distribution or banking distribution. Banking can be I'm quite sure the next 10 years will belong to digital banks. Now the old legacy banks, they will find it very difficult to become pure digital bank because they've got so much of legacy working for them. But the newer banks, they can be very digital in their character. So though we'll buy a classical bank, but it will be a digital bank from the heart. So those kind of things, but I'm clearly very conscious of the fact that next 10, 15 years winner will have a very large portion of the large winners, will be large and fastest. Fastest of course, but even some of them will be larger, like what Infosys did in last 20, 25 years. They took the entire IT segment. They demolished, the amount of wealth created, I think it was just about 1% of the total profit in 95. Now it has become 24% of the total profits.
Yeah.
the expanded profit of that 24% is IT.
Yeah.
So that's what is, I think, this IT plus digital will expand. Maybe that is a new phase of new segment called digital IT or digital companies. And so we have to keep looking for opportunity, and I'm very open to trying to understand the companies which are digitally powered.
Yeah, yeah. So when you put together this list of 25 fastest wealth creators over 25 years, you've been doing these 5-year spells, right?
Yeah.
You must have been surprised by some of the names.
Come again? Which one?
The 25 fastest wealth creators
Yes,
list.
yes.
Did anything really? I mean, which were those companies which you just could not have imagined would become a wealth creator 25 years ago? Because you lived this journey of 25 years.
So two observations which are kind of, one is the Sri Cement. So because the industry is not that exciting, and this one company is up 240 times or something like that.
Yeah.
And it has not taken full 25 years. I think Mr. Bangar took over sometime in turn of the century or something like that.
Yeah.
So I mean, to build something like that, it has to be all internal processes. It is not, see, business is about tailwind as well as the strength of the management. So the tailwind has not been so great for cement in this period, and so it is the remarkable tenacity or management acumen and the focus, and not going here and there, and practicing reinvestment cycle. I think ultimate reinvestment story is the Sri Cement, and they have ended up creating from nothing, I think 100 crores or something, to current 80-90,000 crores with not taken any money from the people. So so that has one thing which has, I mean, I knew that it has done well, but the extent of it has done well. So it is possible that even in a business which is not that tailwinded, a company can, by sheer power, can do well. Second, Infosys.
Yeah.
I mean, was always a darling. I made a lot of money.
Yeah.
And I think they lost the bellwether status somewhere in last 10 years back. And there, I think they're the fastest, by far fastest, like 6-7% ahead of others, like 1,200 times. This is ex-dividend.
Yeah.
If you include dividend, it will be like 1,500-1,600 times. And then, so it was a true bellwether representative of India and did a lot of good to the world, to the country called India, in terms of placing them in a software power kind of situation.
Right.
So they were second largest, but somewhere they lost their way in terms of leadership transition and all. And in that process, the consistency, the market saw it far more negative than actual performance. And that took away the consistency part of it. And it became 61st consistent company.
Yeah.
First is as the fastest, third as the biggest, and 61 as the consistent. And I was very sad not to have put it as an all-rounder wealth creating company.
Yeah.
But even I sold it at some point of time.
Yeah.
And I used to maintain 8-9% in the company. So now we are again back. But I think again the leadership has come back. The same consistent leader of the past, Nandan, has come. And I'm sure he will bring that magic. He must be having some thought process which brings that consistency. Market loves it, what he does. And they are going to get, I think he ended up saying that we are going to get our bellwether status back. But the status is given by the market. So, let's see how it happens. And the company is a magical company.
Yeah.
So,
I've lived 21 out of these 25 studies with you. And one thing I have seen is that sometimes these list of biggest and fastest wealth creators, both by sectors and names, change quite dramatically.
Yeah.
I remember once upon a time PSUs used to rule the roost. The PSUs, were biting dust. Commodities used to rule the roost. You remember the Jim Rogers Hot Commodities book. Yeah. And so, right now, consumers ruling the roost. 28%, 8 out of 10.
Yes, yes.
And numbers are like 80 times P, 100 times P. You talk to Bharat about the same thing, right? Does that bother you? How do you think about it?
Yeah, I mean, there is always a churn. Overvalue. I mean, and there are extremes. Like the value is beaten out of shape all over the world. I mean, it's not only in India. I mean, 7p, 6p, and other side is 90-95p.
Yeah.
Is the color of money different? So, I mean, that kind of question. So clearly, something is going to give in.
I was in fact surprised to see that Hindustan Zinc paid as much
as
Hindustan Lever. I mean, Hindustan Zinc and Hindustan Lever have only one thing in common: Hindustan. Everything else is so different.
This guy is trading at 10p and other guy is trading at 100p or 90p.
Yeah.
So, I mean, it really makes you think, particularly that particular number makes me think, how fair is the market in terms of discounting and all. So, I realized, I mean, we ended up doing in this study, one thing we did was how efficient is the market. So, we called our guru Bhatta and, said, so he said, market is not, bell curve distribution, there is no normal distribution of the market and hence statistical law are not actually applicable.
Yeah.
So I said, then how do we figure out? Still we want to figure out how efficient is the market.
Yeah.
So how many companies, so I said, let me define my own efficiency frontier.
Yeah.
So I said, how many companies fall in 5% plus minus to the average, of the year. And here in last 1 year, the Nifty in 1 year has done 9.5% or 10% when we did this number.
Right.
So between 5% plus minus, guess how many companies would be there?
Fantastic.
Hardly 8-9 companies. Rest of the companies are way out of it.
Fantastic.
The standard deviation is like 31% and year after year.
I talk about efficient market.
Yeah, so I think it is a very inefficient kind of place and we have to only deliver the average rate. I mean, average rate is so much below. So we have to find a framework, maybe QGLP kind of thing, and dedicate ourselves to practicing it. I think it should be possible. I mean, this is a challenge worth taking.
Yeah. So you just spoke that winners rotate, winners change, and you've lived it in 21 years. I've seen it. You've seen 25 years. Now, this value versus growth you just spoke about, 7p, 100p, and there's a lot of there's a lot of literature out there that is being put out that we are at some kind of an extreme and that now a tide will turn, and you are already seeing that to some extent in markets,
clearly, yeah.
So how do you think about that value versus growth debate, and how can it gently influence investors like us who are fundamentally growth investors?
No, so if the growth comes back to these value companies, I'm quite sure if they don't grow, I think I'm pretty happy not doing anything if they're not growing. But if by chance, maybe because of volume or maybe because of price expansion. See, one of the things is that the prices become very flat or it is down. So like oil companies, I mean from $100 it has come to $40, $50. But ONGC cannot make money unless the oil price keeps going from 50 to 60 to 70. So and if that happens, clearly there will be investors flocking into these kind of companies. So if I see in a sustained way the pricing power changing for the commodities, and that can happen in the coordinated infra spend all over the world. I mean, my knowledge is less, but clearly, there's no China happening this time. In last time, 2003, 2008, there was a massive emergence of China, and the world was not ready. This time, it is not like that. There is enough capacity, and China has also happened. So, what is going to happen is the incremental China, or maybe India can emerge. So, I mean, these things, in the global economics, what happens? Because commodities are all global. So, if the global economy picks up big time, I mean, post-COVID, then that is not part of the thing, and we are watching. I mean, we will change styles, or not styles, but the number of companies which we should have coming from the newly minted growth sectors. Yes, we will have them. Like digital companies, we can also have some of the newer companies, newer thoughts, which is there.
Yeah. One of the commonalities across winners is that a vast majority of them are owner driven. What are your insights on that, and why is that the case?
Yeah, because I think India is still passing through the first phase of entrepreneurial journey. Like people like us, we are 63, but we are kind of last 25, 30 years we have built this company. But I remember one of the old man, he used to say, you need the promoters or the entrepreneurs to build the company, but to run it, you need the professionals. So after some because the risk level at the early stage is very different than the risk in terms of growing it or running it very well.
Yeah.
So I think India is entering as a whole into the second phase, where a lot of these successful companies, they will enter the professional phase, and that generation which built it, I think they'll become so big. The next generation also finds it difficult to really get into the boots of the promoter. So and they might be young, they might be 25 years, 30 years, 35 years, wanting to do something else. They have not gone through this hard work. So I think there will be a lot of transition to professional management. Yeah. And the companies which, like even Bharat Puri's company, Pidilite. So there also the professional management has stepped in. We know in Dabur, we know in whole lot of companies where the family management has been. So I think we are watching this, where this successful transition is happening, and sometimes you become insightful, and like we have seen in Britannia, one new professional management can create so much of extra wealth. So among the professionals you have all the choice, but among the family members you don't have much choice.
Yeah.
I mean, you can get tigers among the professionals at a price, but family members you have an option, and unfortunately many times family members are not interested, they're not driven. So what do you do?
Yeah.
So succession is going to be a big challenge.
Yeah. And your study also said that 6 decades back, more than 6 decades back, Phil Fisher said management is 90%.
Yes.
And judging competence and passion of management is arguably a lot more art than just science.
Yeah.
Right? And management can be a big source of failure in investing also. So what kind of management should one just avoid? What are your how do you judge passion when you meet a management? I mean, what are your own, signals to take away to judge that 90% rule of investing?
Yeah. I think if you're not yourself passionate, you cannot judge the passion. So हम लोग पागल लोग हैं, तो ऐसे when you see एकदम ठंडा आदमी, at times you are wrong also. कई बार people by genetically they are very cold, but inside they are like fire.
Yeah.
So you are able to misjudge. But I think if you are in conversation for 2-3 rounds in various locations, that's why I love to see the company in their own location, in their own kind of backdrop, rather than coming here and they made up to the whole thing. Yeah. So I think when you see in then real action, you can figure out what the employees are saying, what the managers are saying, what the competition is saying. Is the competition fearful of these guys? Yeah. How aggressive they are, and how in terms of market share gains and things like that. I think there are a lot of backdrop, and when you meet them, I think generally it meets the numbers.
Yeah.
The numbers and narrative has to match in the passion and all. So, and many times those who are cut above the rest, you can feel it.
Actually, one thing that it resonates more now than ever before is that business and investing is joined at the hip. And Buffett said this many years ago. And when we run businesses, I think it teaches us, based on our mistakes and our achievements, a lot of lessons which you can plow back into investing.
Yes.
Right? And you've been a businessman as much as you've been an investor.
Yeah.
How has that helped you? Is this really joined at the hip, as Buffett said?
Yeah, big time. See, one of the things is that what do you value? What you value is the today's business only.
Yeah.
In any company.
And that's 1% of the profit or 0.1% of the profit.
So the issue is that how much potential this company has.
Yeah.
I mean, look at HDFC. I mean, it was a 10 crore, 20 crore company in 1978.
Absolutely.
Today, that itself is 3-4 lakh crores. On top of it, it has given birth to biggest and best bank. It has given birth to biggest life insurance company, biggest AMC. So how do you figure out in say 80s when you are trading at 100 rupees share used to be available at 120, 130 bucks. Price to book 1 or less than 1 it was available. Right till 90. I used to read every year that balance sheet, and I used to find it the yield used to be 5-6%. So it takes markets are not able to see very much beyond. You have to understand the potential of the existing business and potential of the management running the existing business, and with that growth mindset, what all can he do? How much hunger he has for next 20-25 years. So figuring that out is going to be the real analysis, I would say.
Right. Yeah. No, absolutely. I mean, this thing that for many of these companies, the profits were 0.1 to 1%.
Can't believe it. How the hell you think?
And you're so focused on that 0.1 or 1 with no idea about how the...
I don't know whether even Mr. Nayamurthy was knowing that it is going to be so big a company.
Yeah. There is a lot of hype about ESG, and now passive funds have become the big, game in town, right?
Yes.
At the margin, they are the real marginal investors.
Yes.
In fact, active investors are seeing net outflows.
Yeah. So I think, ESG, I'm here to catch up, to be honest. But some part of it, I practice right from beginning.
Right.
But I think you are better educated on that.
Yeah.
So I would not like to say anything on that. But passive is a very interesting thing. This is a thing which is done, whether I agree or not agree, but the world has gone passive At least US has gone passive, and their passivity is also hurt, impacting us, because they are buying into, because investing has become global for them. And at a top of $40 trillion market cap, when you allocate even 1% more, it brings floods in the rest of the world. That we must be ready to kind of face at this point of time.
Yeah.
So the cost of capital changes completely for Indians in Indian market.
Yeah.
So the valuation is, our 20% growth company, we will give say 20p, but they are very happy giving 40p.
Yeah.
Now what do? You end up selling every day. And those guys are taking it, and they are taking for granted that this low inflation is going to continue and low cost of money is going to continue forever.
Yes.
Because when they go to their bond market, they are getting 1%. What do they do? So I think it is distorting the global markets in a big way, including India. But that's how, you have to prove yourself right in Indian market, on the floor of a stock exchange. Who all are playing, the color is not visible, whether it is Gora, Kala, or passive or active, you don't know. You have to, so what markets will do, as Benjamin Graham said, it will become more and more interesting. And you don't bother about it, and you can never predict what markets will do. Finally, you have to become more and more disciplined at your end. What works for you, please keep doing that.
So my last question, if you were to crystal ball gaze the next 5 years, world of negative interest rates, potential high profit growth and economic growth for India, a lot of reforms are done, the journey to $5 trillion economy. How do you crystal ball gaze stock market, investing, and all of this next 5 years?
See, we are passionate about equity, so we will stay there. It is going to become more exciting, more challenging.
Absolutely.
More failures, more wins will happen.
And
of course, bigger wins will happen. And more surprises will happen, I'm telling you.
More surprises.
So, because every aspect of QGLP is exponential. Quality is exponential, growth is exponential, longevity is exponential, and if you have bought it cheap, then it is super exponential.
Super exponential.
So, we have multiple this thing, and I hope in every company I have all four firing up for me.
Yeah.
So, it is going to be very exciting. In any case, we don't borrow, and we have made a lot of money already. So, I am not concerned about whether I will sink, in the sense that I will be wiped out. The only fear is, can I do a good job for the public's money? There is a trusteeship, there is a implicit promise that we will do better than indices. So whether that will be able to deliver or not, that's the only challenge. But otherwise, so I have decided that I'll manage always, that I'll manage public money, not looking at the index. I'll manage public money, I will manage my own money, and then we'll do the job as best as we can. And I think God will help us finally.
So Buffett's tap dancing to work at 90. You finished 25 years. My best wishes to you for the next 25 years of wealth creation studies. We're very excited.
Yeah.
And I'm sure the magic of compounding, like it works in wealth, will also work in knowledge. And these frameworks,
most biggest compounding is in knowledge.
Is knowledge, yeah. And so
we keep learning.
Yeah, my very best wishes to you. And again, heartiest compliments for the journey of 25 years that you've traveled. Thank you very much.
Thanks, Navin. I think this brings to this entire celebration of 25th year. Fantastic. Thank you very much.
Thank you.